Usually when you're looking to buy a used car
Yeah.
and you see this pristine, high-performance sports car just sitting there on the lot,
Right. Right.
and it has a price tag that says, like, half off, you don't immediately reach for your wallet and start celebrating.
No, far from it. I mean, your first instinct isn't joy. It's just deep, profound suspicion.
Exactly. You walk around it, you check the paint,
You kick the tire.
kick the tires,
Yeah.
and you immediately start wondering, okay, what is fundamentally broken in the engine?
Because, nobody just gives away a Ferrari out of the goodness of their heart.
Right. There has to be a catch.
And that cautious, highly suspicious mindset, it's actually a perfect lens for understanding the psychological state of the broader financial market right now, especially when it comes to one of the biggest software franchises on the planet.
Right. So today, we're taking a deep dive into what might be, honestly, the weirdest paradox in the stock market right now.
It really is.
We've got a stack of fresh equity research and recent financial filings from late August 2026 on Intuit.
Yep.
And we all know them, right? They're the giant machine behind QuickBooks, TurboTax, Credit Karma.
The heavy hitters.
Right. And honestly, the data we are looking at is completely schizophrenic.
That's a good way to put it.
Because on paper, we are looking at a highly profitable, just heavily cash-generative business.
Yeah.
But Wall Street, I mean, the market seems to be pricing this thing like it's a dying legacy brand, heading straight for the graveyard.
It's an incredibly fascinating tension to watch play out in real time.
Yeah.
Because the underlying engine of this company, like their actual day-to-day financials, it's running beautifully. It's humming. But investors aren't looking at the engine today. They're absolutely terrified of the road ahead.
Right. The macro environment.
Exactly. They're fixated on AI competition, looming pricing pressures, and just these general fears that growth is about to hit a brick wall.
Yeah.
And because of that fear, they're just slamming on the brakes.
Okay, let's unpack this disconnect because the numbers here are just stark.
They really are.
Just to set the scene for everyone, Intuit stock had previously hit a 52-week high of $705.08.
Right.
But as of the data we're looking at from late August 2026, it has plummeted by approximately 45.6%.
Wow.
It's sitting at $357.46. So, I mean, it effectively got cut in half.
Which is a price action you normally only see when a company's business model completely breaks.
Right.
Like their revenue falls off a cliff, or they suddenly start hemorrhaging cash.
Right, but they didn't do either of those things.
No.
They just reported their Q4 2026 earnings, and they posted revenue of $4.4 billion for the single quarter.
Just for the quarter.
Just the quarter. That is a 14% growth rate year over year.
Yeah.
And their full year revenue hit $21.4 billion. On top of that, their non-GAAP earnings per share for the quarter was $4.03, which actually beat Wall Street's own expectations.
Right.
So this engine isn't just running, it's winning races while the crowd is basically booing.
Exactly.
So let's look under the hood at their actual financial health versus this, this doomsday narrative Wall Street is spinning.
Well, when you lift that hood, you see that the unit economics of this business are, well, they're frankly staggering.
Yeah.
We are talking about trailing 12-month gross margins of essentially 80%.
Oh, wow.
Specifically 79.96%.
I mean, I want to pause on that because that is elite territory.
It is.
For anyone not staring at corporate balance sheets all day, an 80% gross margin basically means that for every dollar they bring in from a customer, it only costs them 20 cents to actually deliver the software.
Right. It highlights the sheer beauty of a mature, scalable cloud software model.
Yeah.
Once the software is built, adding a new user costs next to nothing. And their net margin, what they keep after all the other operating expenses, is hovering around a very healthy 22%.
That's huge.
But where the story gets really wild and where the market disconnect becomes glaring is their cash generation.
Okay.
Over the 9 months ending April 30th, 2026, Intuit generated just over $7.5 billion in operating cash flow.
Okay, let me stop you right there.
Sure.
Because out of all the research we reviewed for this deep dive, the next number is the one that really broke my brain.
Oh, I know the one.
To generate that staggering $7.5 billion in cash from operations, what do they actually have to spend on capital expenditures?
Just $148 million.
Wait, million with an M.
Million.
Yes.
That is absurd. I mean, Think about that ratio.
It's crazy.
They generated $7.5 billion in pure operational cash and only had to spend $148 million on physical assets, like servers, property, basic infrastructure, just to keep the lights on and keep growing.
It almost sounds like a typo, doesn't it?
Yeah.
It really does.
But that massive gap is why the equity research report refers to a free cash flow proxy of roughly $7.35 billion for those 9 months.
Right.
It's a simple mechanical calculation, operating cash flow minus those capital expenditures. But for a software company like Intuit, it shows just how much pure, unadulterated cash this business spits out.
Yeah.
They aren't constantly reinvesting all their money just to survive.
No.
They are sitting on $4.68 billion in cash and cash equivalents against about $6.16 billion in long-term debt.
So they're flush.
It is an incredibly healthy, fortified balance sheet.
So if their cash flow is practically bulletproof today, but the market is pricing them for a collapse tomorrow, what is Wall Street actually seeing?
Right.
Because we've got major analyst downgrades from TD Cowen's, Diesel, Truist.
Yeah, heavy hitters.
And they've compressed the stock's valuation down to a trailing price-to-earnings ratio, or PE, of about 20, and a price-to-sales ratio of roughly 4.4. For someone who doesn't track these multiples, help us understand how severe that penalty is.
Well, for context, a PE of 20 means investors are willing to pay $20 for every $1 the company earns.
Okay.
If we were talking about a slow-growing brick-and-mortar retail store, a PE of 20 would be totally normal, maybe even a little high.
Right, sure.
But for a dominant tech franchise that is still posting mid-teens revenue growth and 80% gross margins...
That seems low.
It's basement bargain pricing.
Right.
Usually, companies with this specific profile command multiples in the 30s or 40s.
Wow.
The market is completely ignoring this exceptional cash conversion.
Yeah.
They aren't pricing Intuit based on the billions it made yesterday. They are pricing it based on an existential panic over tomorrow.
The AI dilemma.
Exactly.
It all comes back to the fear of being entirely disrupted.
It goes beyond just generalized fear. It's a specific targeted panic that generative AI is going to fundamentally break into its moat.
Well, let's play devil's advocate for the market then.
Sure, let's do it.
Because if I'm a bear, I look at bookkeeping, tax preparation, personal finance advice.
Yeah.
And honestly, those sound exactly like the kinds of rules-based, data-heavy administrative tasks that a large language model could do in its sleep.
Oh, absolutely.
So the fear has to be that some new AI-native startup, or maybe a massive tech giant, is just going to automate all of this for pennies.
Yes.
Right? And that would completely erode the need for anyone to ever log into QuickBooks or TurboTax again.
And that is the ultimate nightmare scenario keeping Intuit investors awake right now.
Yeah.
Imagine an AI agent that just plugs into your bank feeds via an API.
Okay.
It automatically categorizes every expense, reconciles your accounts in real time, and files your business taxes without you ever interacting with a traditional software interface.
Oh, wow.
Right. And if the interface is dead, Intuit's core product is dead.
But management clearly isn't just sitting still waiting for the meteor to hit, right?
No, not at all.
Because the research outlines a defense strategy they call their big bets. They are leaning heavily into their own AI integration.
They are. And if we pull back to look at the bigger picture here, this touches on a massive misconception about how AI actually works in the enterprise software space.
What do you mean?
Well, an AI model by itself is largely commoditized right now.
Right.
Almost anyone can license a powerful language model from OpenAI or Anthropic today.
Sure.
So the actual competitive moat isn't the AI algorithm itself. It's the specific proprietary data that the AI is trained on and allowed to operate within.
Oh, here's where it gets really interesting.
Yeah.
Because it's like the market assumes AI is a giant meteor coming for the dinosaurs.
Exactly.
And they've decided Intuit is just a slow-moving T-Rex.
Right, just waiting for the impact.
Right, but Intuit is trying to prove they aren't a dinosaur at all. They're the ones building the meteor defense system.
That's a great way to put it.
They're telling Wall Street, hey, hold on. We have decades of proprietary financial data, and we are deeply embedded in the daily workflows of millions of small businesses.
That is the core of their argument.
Yeah.
Intuit believes their proprietary data advantage will naturally translate into vastly superior AI-powered experiences.
Because they have the history.
Exactly. If they execute this correctly, AI isn't a disruptor, it's an accelerant. It could actually increase their average revenue per user.
Wait, really? Increase it.
Think about it. If they can automate more tedious tasks for a business owner, they make their product stickier.
Oh, I see.
They gain pricing power, and they reduce the cost of acquiring new customers because the product practically runs itself.
Okay, I have to push back on that, though.
Okay, go for it.
Is historical data really enough to stop a cheaper, sleeker AI competitor from stealing market share?
Well,
I mean, if a brand new startup comes along and offers an AI accountant that is 90% cheaper than QuickBooks, aren't small businesses just going to jump ship to save the cash?
it's a very valid question, and it's exactly the reason analysts at TD Cowen and Stifel are citing concerns about pricing pressure.
Right.
However, you have to factor in the sheer weight of switching costs in the real world.
What do you mean by that?
Well, think about a small business owner. Let's say a local plumber with 10 employees.
Okay.
The idea of spending a Friday night trying to migrate 3 years of messy payroll data, employee tax IDs, and vendor invoices over to an untested, unproven AI startup just to save $20 a month.
It's a nightmare.
It is a nightmare. The headache factor is immense.
Yeah.
That workflow embedding is a massive friction point for churn.
So they just stay put.
Exactly. Intuit's bet is that if they can provide AI automation inside the secure system the plumber already uses and trusts, that plumber isn't going to leave just to save a few bucks.
That makes total sense when you put it in human terms.
Right.
It's essentially a trust premium. When you're dealing with the IRS or making sure your employees' paychecks clear on Friday, you really don't want your discount AI hallucinating a tax return.
The stakes are simply too high for most businesses to experiment.
Yeah.
But here is the catch. To prove this meteor defense system actually works, Intuit can't just rely on trust forever.
No.
They have to deliver tangible, indisputable results to a highly skeptical market. Corporate buzzwords about AI won't cut it anymore.
Which brings us to their future map and how management is actually responding to all this pressure.
Yeah,
Because they're definitely not backing down.
not at all.
According to the filings, they have guided their fiscal year 2027 non-GAAP earnings per share to be between $22.88 and $23.12.
Which is a remarkably bold line in the sand.
Yeah, it is.
Hitting that target represents approximately 23% earnings growth year over year.
23% earnings growth
Right.
for a stock currently trading at a bargain bin PE of 20.
It's wild.
If they actually hit that, this stock looks like a tightly coiled spring ready to explode upward.
It really does.
But to get the market to actually believe that guidance, they have one ultimate catalyst coming up.
Yes.
The research circles one single date on the calendar, and that's September 17th, 2026.
Their investor day.
Yep.
This raises one of the most important questions of the year for this stock, which is, can management successfully change the narrative?
Right, because investor days are classic sentiment inflection points.
Exactly. Intuit has this one major stage to directly confront the AI fears.
Yeah.
They need to present a multi-year growth roadmap, show off actual measurable AI product milestones, and conclusively prove they are an AI beneficiary, not a victim.
If they nail that presentation, they could completely reset market expectations.
Oh, absolutely.
But as I was reading through the data, I found a massive contradiction that I want your take on.
Okay, what is it?
So we've got management publicly projecting 23% EPS growth. We've got a stock that's been cut almost in half, trading at a historic discount.
Yeah.
If the executives are so wildly confident that Wall Street is wrong, you would expect them to be buying the stock hand over fist, right?
You absolutely would. You'd look for a wave of insider buying to signal conviction.
Exactly. But the insider activity section of this report shows absolutely zero open market purchases.
Nothing.
None. And in fact, there were 5 tiny sales totaling 1,572 shares.
Right.
Now, I know 1,500 shares is small, but if management is sitting on a coiled spring, why aren't they buying their own stock at these supposedly discounted prices?
The research actually flags this exact contradiction as a cautionary signal.
Really?
Yeah, while the sales volume itself is minimal. I mean, 1,500 shares is practically a rounding error for executives at a $100 billion company.
Right, they're probably just selling for tax purposes or something.
Exactly. But the total absence of conviction buying hands the bears a really strong talking point.
Oh, I see.
It suggests that while management is publicly projecting supreme confidence with their 23% growth guidance, privately, their own wallets are staying closed.
Wow.
They might be waiting to see how the next few quarters of this AI transition actually play out with customers before they risk their personal capital.
Wow. So a coiled spring can bounce, but if the metal is weak, it can also just snap.
That's the fear.
We really have to weigh the ultimate optimistic scenario against the cold, hard reality of what the stock chart is actually doing.
Yeah.
The report outlines what it calls a blue sky scenario for the next 2 to 5 years.
And we should explicitly state, as the research carefully does, that this is a highly optimistic scenario, not a guarantee or a baseline prediction.
Right, absolutely. But in this blue sky world, Intuit successfully transforms from a traditional software company into the dominant AI-powered financial operating system.
Right.
The migration of legacy desktop users to QuickBooks Online rapidly accelerates.
Yep.
Credit Karma uses AI to expand into entirely new lending verticals.
Huge growth potential there.
And because they are delivering so much automated value, their margins expand even further. And Wall Street realizes they were dead wrong, re-rating the stock significantly higher.
That's the fundamental bull case right there.
Yeah.
Revenue growth reaccelerates beyond the current 14 to 15% range because AI unlocks brand new ways to monetize their existing user base.
But then we flip the page and look at the technical reality on the chart, which is a bit more sobering.
That's a different story.
The stock is showing some signs of life. Recently, it's up 11.73% over the last 13 weeks.
Okay.
And it recently crossed above its 20-day moving average, which sits at $339.80, and its 50-day moving average at $302.42.
Well, those are definitely positive near-term signals.
Yeah.
It shows some intermediate-term momentum is building, possibly representing early accumulation by investors placing bets ahead of that September 17th Investor Day.
Getting in early.
Right, but we have to balance that fundamental optimism with the overarching technical reality. Because the stock is still trapped well below its 200-day moving average, which is way up there at $436.71.
Okay, so crossing the 20-day and 50-day averages feels a bit like life support kicking in.
Yeah.
The patient has a pulse again. But that 200-day moving average is essentially the final boss they have to defeat to prove the bears wrong.
That's exactly what it is.
For a listener who doesn't stare at stock charts all day, why is that 200-day average such a massive hurdle?
It all comes down to human psychology.
Okay.
That 200-day moving average is essentially the dividing line between a healthy trending stock and a broken one.
Right.
It represents the long-term trend of the past year. So right now, it acts as heavy resistance because of bag holders.
Oh, right.
There are investors who bought the stock way up at $400 or $450 before the crash.
And they're just waiting.
They are. Every time the stock tries to rally and gets close to that price, those trapped investors use the bounce as an opportunity to sell and just break even. And that wave of selling pushes the price right back down.
So until they can chew through all that pent-up selling pressure, they're basically stuck.
Exactly. Until the stock forcefully reclaims that $436 level on high volume, the overarching long-term downtrend remains intact.
Wow.
The broader market is still treating Intuit as a potential value trap.
Right. A stock that looks cheap on paper, but it's cheap for a very good reason.
Precisely.
Yeah.
And the primary fundamental risk that could validate that value trap theory is if their fiscal year 2027 quarterly revenue growth slips below 12%.
If that revenue growth dips below 12%, then all those AI fears we talked about suddenly look justified in the actual data.
They become very real.
The market will say, see, the new AI competitors are officially eating into their market share.
It would be the ultimate confirmation of the bear thesis. If growth permanently decelerates into the single digits, a PE of 20 might actually be appropriate or even slightly expensive.
Right.
The entire constructive thesis right now relies on the belief that the market is currently overpricing the AI disruption risks while severely underpricing the incredible cash flow reality.
So bringing this all back to the core tension we started with, we have an absolute cash machine spitting out over $7 billion in free cash flow, operating with elite 80% gross margins,
Wow.
and boldly projecting 23% earnings growth.
Right.
But on the other side of the ring, we have deep existential market paranoia that AI is going to commoditize their entire business model.
It is arguably one of the most compelling setups in the software sector right now because the gap between the trailing financial fundamentals and the forward-looking market sentiment is so unusually, historically wide.
So for anyone tracking this narrative, there are basically three crucial elements to watch over the next 6 to 12 months.
Yes.
First, the Q1 FY 2027 execution. Do they maintain that 14% revenue growth, or does it slip below that 12% danger zone?
That's critical.
Second, that critical September 17th Investor Day. Do they show up with real workflow integrated AI products or just a slide deck full of corporate buzzwords?
People want to see the goods.
Exactly.
And
Third, that $436.71 technical level. Can they chew through the sellers and defeat the 200-day moving average final boss?
if they can align flawless fundamental execution with a highly convincing strategic narrative on September 17th, the technicals on the chart will eventually follow.
Yeah.
But if they stumble or if the AI narrative feels hollow, the market's punishment over the last year has already shown it will be incredibly severe.
It really leaves you wondering about the bigger picture, doesn't it?
It really does.
I mean, beyond just Intuit, does the current AI panic in the market mirror the early days of the internet?
That's an interesting comparison.
Right. Back during the dot-com bubble, everyone assumed the old guard brick-and-mortar companies would be completely wiped out by agile, pure-play internet startups.
Oh, absolutely.
But it turned out the legacy companies who actually adapted became the ultimate winners because they already had the massive distribution networks and the deep customer trust.
They had the foundation.
Exactly.
Yeah.
So if data is truly the new oil of the AI revolution, aren't the legacy companies who have been quietly drilling and storing that data for decades actually the most dangerous players on the board? Something to think about.